Hello, and let's get started. Welcome to eOption's webinar, and we're excited to have you here. And thank you for taking the time out of your day to join us. Happy St. Patrick's Day today. We're excited to partner with our speaker, a professional trader with over 30 years of experience, to bring you this webinar on Soar through market volatility with Iron Condor Option Spreads. My name is Gina Bocayas, and I'm with Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. And to provide some basic logistical information of the webinar, the session will last approximately 1 hour. Our speaker will talk for about 45 minutes, and the last 10 or 15 minutes will be for question and answer. So if you have any questions at all during the webinar presentation, please feel free to type them into the question box on your screen, and our speaker will answer those at the end of his presentation. We ask that you please use the Q&A box and not the chat box, as our speaker may not see what's entered in the chat box. We also see that some people are raising their hand, and we ask that you put any questions into the Q&A box. You can access the recording of the webinar in the next week on our website at eoption.com, and we'll also be emailing you a copy of the recording in the next week so you can view it at your leisure. You'll also find it on eOption's YouTube channel, and we recently revamped, and we have all kinds of playlists no matter what level you're at. So we have one on option spreads or beginning option trading or using our tools. So we encourage you to check it out. And for those of you just joining, we'd like to welcome you to our webinar on Soar through market volatility with Iron Condor Option Spreads. And as eOption's name implies, we're a firm that specializes in option and stock trading. Our founder was a founding member of the Chicago Board Options Exchange in the 1970s and has been trading stocks and options for nearly 50 years. And we charge some of the lowest option rates in the industry. First, all of our stock and ETF trades are commission-free, and options are just 10 cents per contract plus $1.99 per trade. So if you want to trade 10 contracts, it's just $2.99 per trade, which is a lot lower than many of the large competitors out there. We also offer a powerful trading platform, a mobile app, free trading tools, and live expert support on our trade desk. And that's something we're really proud of, is our excellent customer support, where our professionals are licensed brokers, most of them with over 10 years of experience, and you can reach out to them with any questions. So you're not just limited to an app where you can't speak to someone when you have a question. We also offer a useful options trading tool called Options Play. This scans thousands of stocks each day to highlight potential option trade opportunities for you. And normally that's $500 annually, but it's free for all of our customers. We also support option education, and we're glad you can join our webinar today to learn more about using options in your overall trading strategy. And I'd like to turn our attention to our speaker now, Teddy Keckstadt. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption, and we're excited to welcome him back today. And just to tell you a little bit about him, he has over 30 years of trading and industry experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years, and has been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked, and he is the author of the book, High Probable Japanese Candlestick Patterns. He also has a degree in finance from DePaul University in Chicago. And without further ado, I'll turn it over to Teddy Keckstadt. Thank you.
Thank you, Gina, for that introduction, and thank you everyone for showing up today for our webinar on Iron Condor Spreads, and happy St. Patrick's Day. All right, so we're going to put up our disclaimer real quick from eOption. This is just to remind you that this webinar is for educational and illustrative purposes. Everything is in behind time. There's a lag here as far as the information, so none of this is currently going on in the marketplace as we're speaking. All right, also I put up my disclaimer as well. For every webinar I do from Forex Trading Unlocked, I can bypass that. So what you will learn today, you're going to learn how to trade stock and other market movements without large capital allocations. That's a beautiful thing. You're going to learn how to expand your portfolio diversification through the use of these option strategy you're going to learn today. You're also going to learn how to maximize your potential returns with options. This strategy is a neutral range-bound strategy typically, for the most part. However, I'm going to show you how it can be used for directional traders as well. And we're going to show you how eOption can help improve your bottom line because of how low the costs are for trading options like Gina just spoke of. All right, so why stock option strategies? First of all, it helps to lower your cost basis, which we just mentioned. Options help you to diversify your portfolio because you can trade a much broader range of stocks with your allocated capital. The stocks we're going to talk about today for these strategies is Microsoft, Amazon, and Tesla. Some of those are, especially two of them, are very expensive stocks, and to trade those just on an individual equity basis takes a large amount of capital. However, through the use of options and strategies such as Iron Condors, like we're going to talk about today, you can take advantage of market moves in these very watched and heavily traded stocks. Options allow smaller to larger investors the ability to capitalize on these trending markets that are highly liquid. This is a very important cost control. Remember, the trading is a business. The whole point that you are investing or trading is to make money. It's not a game. It is not gambling. It is a business. As long as you treat it as such, you will have typically the results of running a business if you run it properly. Trading in these products is similar to trading in normal equities, but with higher potential ROI and controlled risk. So your return on investment is much higher by using strategies such as the Iron Condor that we're going to talk about now. Okay, today's focus, the Iron Condor Option Spread. So first, you're going to learn the moving parts of this option strategy, okay? You're going to learn what to look for. And you're going to learn this is a new approach also on how to use an Iron Condor. What everyone else knows is not worth knowing. That's typically what most traders will tell you. The more you're involved in the markets, investing or trading, you'll learn how to analyze markets, and you'll know a lot of things and see things that most people will see. How you profit in the markets is not knowing what everyone else knows. It's knowing something that everyone is not looking at or utilizing properly. And that's those little discrepancies is where you can jump on and capitalize on. Simplicity is the best. This technique we're going to learn today, even though it involves the use of 4 options, is actually a very simple strategy to use, and simplicity is always the best thing. The less moving parts, the harder it is to the less likely it is to get screwed up. The more moving parts, obviously the more things that can go wrong. One nice thing about this strategy is you can actually, we're going to show you how you can ignore the Greeks. You're not going to have any math anxiety. With a lot of different option strategies and ways that you can apply options, you need to pay attention to certain different variables in the Greek, such as the theta, the delta, and what have you. With this one, your market bias or no bias, anyone can apply this strategy. For the most part, though, you are fairly neutral on the equity underlying asset that you're looking to put this spread on. And the best thing about this strategy, best of all, is you get paid first with defined risk. That's right. This is a credit spread. So when you put this strategy on and implement it, you will be taking money into your account. So what is an Iron Condor option spread? This is what an option condor spread is, the parts. An Iron Condor involves 4 separate contracts, okay? So you're going to use calls and puts in a combination together simultaneously. So it involves selling of 1 call spread above the market and the selling of 1 put spread below the market. So when you combine both selling the call and put spreads together, that is when you call it, it becomes an Iron Condor. So if you were to just use 1/2 of this Iron Condor, then you would be selling a call spread or you would be selling a put spread. And these are when you would be either bullish or bearish the market, and you can trade directionally when you use those kinds of spreads on their own. When you put them together, it's a different story. And we'll show you once we get to the charts, it'll all become very clear for you. The key thing to the Iron Condor spread is that the same expiration month for all contracts is a must. They are all from the same month, no matter what. At the time of when I started to make this video, I used the April 1st, 2021 expiration date because that was between 30 and 45 days. Between 30 and 45 days is typically the ideal scenario for this type of option spread. You can do it with a shorter time frame. However, ideally, and you'll see why once we get into it, and especially as we wrap it up, why you can do it once, like I said, with only a week or 2 out, but when you initiate it within the more closer to 45 or within 30 days, you'll get more bang for your buck. Okay, so all four contracts are out of the money, otherwise known as OTM. It is not a mandatory requirement. Sometimes the underlying equity may have one of the strike prices pretty much right on that level. Like for instance, if the stock price was $25 or $25.25, you could theoretically you could use a $25 strike price put. We'll get close into that as we get to the charts. But it is not a mandatory requirement that the equity be exactly in between the two spreads. The call and put spreads are of equal width. So what that means is that the distance between the two call options that you put on has to be the same distance in strike relationship to the puts spread that you put on. So for instance, when we get to the chart, this will become very clear as far as equidistance for those two spreads. Usually the underlying asset is a broad-based market index like the Russell, the SPX, the NASDAQ, the NDX, et cetera, the S&P 500. That's why a lot of people, when you talk about iron condors, they assume that whoever's trading that there's someone who is an index trader. Like I was in the S&P 500 pit, people who were trading, there was a lot of iron condors that were sold in that options pit. It's just like the OEX when I was over at the CBOE, the iron condors were very big in the OEX pit as well. So the thing is, you don't need to trade just indexes, especially when you talk about stocks like Amazon, Tesla, and Microsoft, very liquid stocks like we're going to look at. You can use these strategies as well. So this is a neutral trade that lacks any bullish or bearish bias. So you are neutral. You can have a bias, but basically you're not looking for any severe bullish or bearish move. So you may be slightly bullish or slightly bearish, but you're not looking for an overall trend to develop during the time that you have the spread on. Okay, now selling the call and put spreads creates a credit that equals the maximum profit that you can make. We're almost at the charts, folks. This is all going to become clear. We're going to have all kinds of colors and lines and we'll be jumping out at you. Remember, selling the call and put spreads creates a credit. That means you're going to bring in money that's going to be deposited into your account. That amount of money minus your commissions is the maximum profit that you can possibly make on this spread. You cannot make more, no matter whether the market doesn't move for the next 2 months, 3 months, whatever, through your spread and expires, or whether it rallies or breaks to zero, whatever, the company goes out of business, whatever, the maximum profit you can have is that credit minus your commissions, okay? Also, this is also considered buying the iron condor, but you do not need to think about it as that if it gets confusing. So we are going to be selling option spreads, which means you get a credit. And normally when you say selling, you are short. However, because of the nature of this spread, because you're combining two negative spreads, options traders typically say when they're trading iron condors that they're long in the condor. So with that, let's get into one last quick little roundup. And how do you make and lose money in the iron condor? Because that's what you guys are really here for. You don't want to listen to me babble about all the little intricacies. You want to know how to do it, what to put it on, and how much money can you make. So here's what we're going to get into right now. Your expectations are that the underlying assets stay in a range. You will learn how to overcome this at sometimes. When expiration arrives, you keep the whole credit, commissions if all options are out of the money, okay? Or minus the commissions if all the options are out of the money. Do not expect that to occur every time. Just because you put on an iron condor trade, it's like any trade. You're not going to make money all the time. Doesn't mean you're going to lose money. You'll have the opportunity sometimes get out of a credit spread or a spread like this with a scratch, or just a small profit or small loss. Doesn't mean you're going to lose what your defined risk is. But remember, that's the thing, is that when you take in that money, just like you have a defined profit potential, you also have a defined risk also. All right. It is usually preferable to give up some of the credit and exit the iron condor early. Good money management is to not get greedy. It's like the old adage, pigs get fat, hogs get slaughtered. Don't be a hog. I'm telling you, every hog I've seen in the trading business isn't there anymore. Money management is key to all traders' success, period. Nothing more needs to be said on that. Sometimes the market explodes. That's why these things can go against you. But remember, you have defined risk. And when you see the spreads that we put on today, and if you get them priced out right, we can even limit that even more. So that is not good for the Iron Condor when markets explode, but you will already have the defined risk once again. So there is no stress about losing more than expected. So that's the nice thing about a trade like the Iron Condor. You know what you're going to make, most likely, if you are right, and you definitely know the most that you can lose. And it's always locked in. There is no changing that. You don't have to worry about that. Nothing else changed. It's not like when you put on certain other spreads or if you have outright positions. So here's another thing to remember. If the market doesn't move, if the market actually does move, let's say you have an extreme rally to the upside or an extreme break to the downside, and you go beyond your option spreads, you are only going to lose on one leg of the spread. Leg meaning one is the put spread to the downside, and then there's a call spread to the upside. Those are your two legs of your spreads. The market can't go in two directions at once. You know, it can only go in one place. If anyone knows how the market can go in two places at once, please let me watch your webinar. So, but anyhow, because of that fact, you can only lose on one leg, which that means any credit you take in from the leg that you won on, that you profited on, that goes to cover your losses. That's how you define your risk. So no matter what, one spread will be profitable no matter what. Okay, depending on the underlying asset, the probability of the loss can be lowered, but the profit potential will fall as well. So to do this, you would choose out of the money options that are further away from the current market. The same is true for the opposite. Options that are closer to the current market will increase the risk, but also raise your profit potential. So it's a simple thing, risk reward. The more risk you take, the more potential rewards you have. And the more risk you take, the more potential, risk you obviously have as well. So the best is to find options that fit your style and level of experience. Typically, people trade the index markets, like I said, for the Iron Condors, SPX, NDX, and Russell, what have you. Do this only if you understand index trading as well. So that's where, when it comes to these equities, I like to suggest this to more traders and investors as a strategy for equities and not the indexes, because stock indexes have a whole meaning of their own as far as how they wiggle and jiggle and the pricing and stuff. So if you're not familiar with that, it gets really hard to become to put option spreads on that. So until you're experienced with it, please stay away from it and take your time before you try and do it. I lived in the S&P 500 pit. Trust me on this one. So anyhow, stay in your comfort zone. Stocks you already follow is where you should start. So for instance, like Amazon, Tesla, and Microsoft, which I chose for today, I would think that almost every one of you that are watching this webinar are somewhat familiar with those companies. So, and if you're not, then you just use the same type of strategy on ones that you are. So by the end of this webinar, you will also learn how to establish a no loss scenario. That's right. How about that one? Every once in a while it happens, but guess what? I'm going to show you when it did and how it's happening right now. So patience and discipline are key to profiting from Iron Condors, just like everything else. So here we go. Here's the pictures. What do we have here? We have the Microsoft Corp here. So when I started this webinar back a month ago and laid out the different options for this and where the market was, Microsoft was trading at $228.99. Irony of it all today is that Microsoft is trading at $234.32. So you know what that means? That means it puts the stock pretty much right around where it was a month ago. That is something that's good for this type of strategy. So that means as we're getting closer to expiration, remember all these examples I'm going to show you have an April 1st expiration. So in this case, the market, like I said, was $228.99. So you would be selling the 240 call, you'd be buying the 250 call, and you would get a credit for that. You would also sell the 220 put, excuse me, and you would buy the 210 put back. That would give you a credit. The combined two credits minus your position is your maximum potential profit. Your maximum risk is the difference between, depending on which way the market goes. So if the market rallies, you would subtract the credit that you had from both spreads, and whatever that difference is from your first one, that would be your loss. So and you'll see when we get to the math on this one. So what it means is that you can only have a risk like here, there's $10 wide, it's 240 to 250 and 220 to 210. Your maximum loss is $1,000 or 10 points. Okay, so $10, which would be $1,000. Remember, you took credits for both legs. So if you take, say, 3.5 on one and 4.5 on another, that gives you 8. The most you could lose is 2. So depending on which direction it would be, that would be the one credit would be you would absorb your loss, and the other one would pay to pad part of your loss. So let's look at the pricing here. So for the Microsoft Iron Condor, with an April 1st, 2021 expiration at the time of this webinar writing, once again, Microsoft was at $288.83. You could sell the 240 call for $4.74, buy the 250 call for $220, which gives you a credit of $2.54, which is equal to $254. Okay. You could sell the 220 put for $5.59 and buy the 210 put for $3.70. That gives you a net credit of $1.89. So that's $189. So the total Iron Condor credit at the time of this webinar, when I first was making these charts up, was $443 maximum potential profit and a $557 max potential loss. So this is a situation where if you are very neutral Microsoft at the time when this trading opportunity, if you wanted to take a snapshot back then and do this trade, you know that you had a potential to lose more than you could make on the trade. So unless you had a real big reason to think that volatility and momentum of whatever the trend or non-trend was at the moment would keep the stock or underlying asset within the boundaries of your call spread and your put spread, then I could see where you might want to put on this trade. But I personally like to have a profit ratio of 2 to 1 or more. In this case, you're not even 1 to 1. So I would say, unless you really, really know your Greeks, and then that gets into other numbers that starts to get into a more speculative way, I would not take this trade. You don't take every trade just because, I mean, this one is actually not a bad one. It is a decent credit for the Iron Condor. However, I like to always have at least a 1 to 1 or more profit potential. Otherwise, I just don't like the trade, because over time you have to just be right more often. That's just one of the realities of it all. So, but this means that still there was a trade here. Now, if you did do this trade, just to give you an idea, we said that the credit, the total net credit, was $443, okay, for this trade. If you were to put this trade on right now, this exact same, because the market is actually near the same price, you could put on the same credit spread now for, it would be a net $2.50. So had you done this spread back then, you could buy it back for $2.50, and you would basically make $200 or base $2, around $2, just under $2, had you done the Iron Condor then. If you had put on the spread back then, and you were still in it today, being that the market is 2 weeks before expiration, and you've already made half of what you possibly could make, this would be a trade where I would say then you would execute your positions and get out of them. Because this way, instead of giving up having the risk potential over the next 2 weeks where the market moves, there's not much left to make on this to begin with, but your loss potential is huge, especially even though you have only a 557 loss potential, because the spread's at 250 right now, the current potential loss is 750. So take the money and run if you would have the spread on, is what I'm saying. Once again, I wouldn't take it unless it's more than 1 to 1. So now let's get into one that is. So for Amazon, we have, this one is a high flyer. What is a neutral range for this? $1,000 wide? Pretty funny, right? So at the time of this spread, when I did this setup, it was trading at $3,057.16. Amazon, ironically, today is trading at $3,057.16. So it's just a little bit lower than where it was at that time, or excuse me, a little bit higher than where it was at that time. It is within the parameters of our call spread to the upside, which remember you would be selling the 3,115 call and buying the 3,125 call. And then also it is it is above the 290, or excuse me, the 2,990 put and 2,980 put that you would be buying back. Let's look at the numbers on this one. This is where looking at for spreads like this is where you might start to say, oh, I know I see what he's saying about not taking the first trade, but looking at this one. So Amazon was trading at $3,057.16. At that time, you could have sold the $3,115 call for $116.67 and buy the $3,125 call for $108.55. Remember, these numbers are times 100. That's how expensive these options are. They're times 100. Okay, so your credit is $8.12, which is actually $812. Now think about this. We just looked at an example. You're going to be selling 2 credit spreads. You know your maximum risk is $1,000 minus whatever credit you take in. Just from one leg of this spread, you can take in $812. That only leaves $188 of potential risk left, and you know you're taking another credit. Let's move on forward, shall we? Sell the 2,990 put for $100.55 and buy the $2,980 put for $90.24. That gives you a credit of $10.31 or $1,031. That's right. At the time, the volatility was so high with Amazon, even though it was fairly in a neutral range because of the way the stock indexes were actually moving, that some of these options, because of rotation of other spreads and calls and puts, the disparity was so huge that you could get a credit off of just the one leg right there of $1,031. So if you just sold the put spread, you knew no matter what, you'd make $31 no matter what, minus commissions. You couldn't not, no matter what happens to the market, whether it goes market tanks or rallies or stays the same. And now you have a credit of $812 on the call spread. Total Iron Condor credit is $1,843. That's your maximum potential profit. That's if Amazon goes nowhere and you hold it all the way to expiration. Your maximum loss potential on this trade, because it's more, your credit is over $1,000, your maximum loss is absolutely zero. That's right. It's an absolute zero. It means that had you been paying attention and trading that day and watching, looking for a spread like this, when volatility is spiking, because you want volatility to drop when you put on a spread like this. If you're in a situation where you have a high liquid stock that's trading near its highs, in a situation like this where it's the indexes also have a lot of influence on the stock, and the stock has an influence on those indexes. That means you have all kinds of funky different spreads going on for other options plays. Besides the Iron Condor, there's a lot of different types of spreads out there. Straddles, strangles, all these things people have heard of that are very common. There's all kinds of butterfly vertical spreads, and we could talk all day long on different names if we wanted to, you know, and because of that, and because of the rotation of these things, there's opportunities every once in a while with high volatility. Normally, you wouldn't see it more than probably around $600 to $700 for a credit. But whenever you see a credit on a spread like this, where you can get, like, for instance, like I said, the calls, like the call spread, where you have $112, if you initially just wanted to put on a call spread, at that point, you would look to do an Iron Condor, because you know that if you can get, if it's close enough and has even a small credit, all you had to do is have more than $1.88 for a credit, and you would be at, no matter what, you could not lose money. So is it possible to get trades off like this? Absolutely. I took them off. And now let me tell you where this is at right now, because you're probably like, oh, genius, where is this trading now? So just like we said, the total credit for the spread is $1,843. Right now, the Amazon spread, if you could put this exact same spread on for $5.89, which equals $589, that's still a reasonable number. That's right around the 1-to-1 ratio. Okay, so with 2 weeks left to go, if you think Amazon's not going to break out, you could still put on this spread right now as an Iron Condor, sell that call spread and that put spread and then be technically long the Iron Condor, remember, and you would have that potential. However, if you had done it a month ago and you had this situation, you could do nothing no matter what, because you know you can't lose money. The worst thing that could happen is the market explodes to the upside above your call spread or explodes to the downside below your put spread, in which case you would then only lose $1,000, you would still make $843 profit. That's if the market exploded. So in this situation, you wouldn't do anything unless you wanted to rotate your capital, in which case, since you got a credit of $1,843, you could sell it back, buy it back for $586. You'd be basically making, that's another $1,200, $1,300, depending on your commission basis, that you would have made in 1 month with having zero risk whatsoever. So, but this is something, remember, these opportunities, they don't happen all the time, but when you're looking for more than a 2-to-1 profit ratio or more, like I said, when you see a credit spread where you have a call or a put spread that is higher than $700, let alone $800, then don't focus on just that. Look for the other side, make it into an Iron Condor instead of a call spread or a put spread, and give yourself a situation where you cannot lose. It's impossible. You cannot lose at all. If you are a gambler, this sometimes happens when you're betting football and stuff like that. And I'm not going to get into that kind of thing, but it's where you basically have one bet riding, and then you have odds where you can also hedge it with another one. And whether you win or lose on either one, you end up making money. So anyhow, that's a whole nother topic, but that's kind of how this method works. So Tesla, this is going to be a similar one as well. At the time when I did this, figured out these spreads, this is another one, $682.22 is where the market was trading. So in this case, we would sell the 705 call, buy the 715 call. So that call spread, you would sell that for that credit. And then you would sell the 660 put and buy the 650 put for a credit. And that would establish your Iron Condor. Remember, the Iron Condor is the combination of a call spread and a put spread. All right, let's see what would have happened. Tesla Iron Condor, April 1st, 2021 expiration. We have Tesla trading at $682.60. You sold the 705 call for $56. Buy the 715 call for $51.08. That gives a net credit of $4.92 or $492. That's a pretty good credit. When you remember, you're looking to get around, if you can get around 700, especially, or 800, you're really golden. And this is one where you're like, okay, well, this is already at almost a 1-to-1 ratio just for one leg. The next leg, this is another interesting one. You sell the 660 put for $59.70 and you buy the 650 put for $50. That gives you a net credit of $9.70. which equals $970. Now, remember that these option prices that we've been talking about, especially with Tesla and Amazon, even though these options cost, for instance, $5,000, $6,000 per option, remember, because you're doing them at the same time and it's a credit, it doesn't matter. Your only difference is the difference of your strike price where your credit is. You don't have to worry about the true pricing of the options because they net out. So once again, this would yield a credit of $970. That means that this put spread alone, you only had a risk of $30 if you were wrong, just on a put spread. If you have obviously an Iron Condor, that means that this one leg eats up $970 of your potential $10, $1,000 risk, which means there's only $30 of risk, or 3 cents actually, 30 cents. Because of the two spreads, the total Iron Condor credit, which I did this one also, was $1,462. Now that was your max potential profit. Remember, your max potential loss is 0. You can't lose, because your maximum loss, if the market was to explode above the call spread or fall below the put spread, remember, you can only lose on one leg of the spreads. You can't lose on both. The market can't be in two places at once. This one, no matter what, yielded a credit that if the market did explode or it did go to the upside or downside, you cannot lose. And the most that you would, then the least that you would make would be $462 profit. That's right. That's the worst thing that could happen to you. Now, you're probably wondering, well, where is this spread at today? Well, remember here, you could have gotten it off for its 1,462. So that's 146, 46.20. Right now, you could sell that spread for $8.85. So just right now, you could do for 2 weeks, you still have, this would be the one of the three with 2 weeks left at expiration. This is a trade that if this one wasn't on already, I would put this one on because you only have a risk of $1.15 for this trade. So, and with this one here, because of where you can buy it back, I mean, why would I not leave it when no matter what, the maximum I can lose, the worst thing that can happen is I make $462. So if I was to get out of it right now, I only make around 700 or 600 and some dollars on the spread. So for me, to risk to a couple more weeks to make anywhere from $200, to another 1,000 on the spread and keep that locked in, I think I'll take the risk on that one. So as far as now you can see how when we started off with the first example, how it was a 1-to-1 ratio, and it gave you an idea that, well, for a little while, put it on and it was profitable. You could definitely get out of it. That Microsoft spread right now, remember, was at 250. You could have made money off of it. All of these spreads you could exit right now had you put them on a month ago. But the nice thing is that when you, like I said, if you wait for moments of super high volatility and then you look for, even just when you're shopping around for call and put spreads, when you start to see them creep above $500, $600, $700 and they're fairly close to your underlying market price, asset price, look to the other side for the other leg, be it the put spread or the call spread, to see what kind of a credit you can get. And then when you do that, you're locking in the closest thing to a surefire winner, or, even in these situations, you would be able to start out where literally you have a credit in your account and all you have to do is wait till expiration. And remember, you can let these expire worthless, or you can get out of them yourselves. I typically get out of them myself a little bit beforehand, just because anything can happen in the marketplace. And when you only have a couple of days left, those couple dollars, once again, I said in the beginning, don't be a hog, be a pig. Pigs get fat, hogs get slaughtered. So don't be afraid to take a profit, and don't try and get every single penny out of every strategy. Trying to do that is just as bad as trying to hang on to a loser and adding to a loser, which is a whole nother story we don't want to talk about. So now you can soar through market volatility with Iron Condor Option Spreads. And we're going to get to some of these questions because they're building here, and I wanted to make sure that I had plenty of time to answer them. So once again, today's focus, before I answer these questions, the Iron Condor Option Spread recap. You learned the moving parts of this option strategy. It's combining a put spread and a call spread. You learned what to look for as far as pricing and what kind of equity to look at. Remember, start with these high-flying, heavily traded equities before you do the indexes. Once again, I tell you, do not forget this. If you learn anything about this Iron Condor strategy, please do not apply them to any index until you are experienced with indexes as well. This is a new approach. What everyone else knows is not worth knowing. Not many people tell you how to find the credits and build them up to where you can put more than a 2-to-1 to upwards of 3-to-1 profit potential in your favor, not to mention finding how you're going to lose when your credit is above the total risk you could possibly have. So remember, you want to look for high volatility moments for that kind of thing. And then, because once you're really pushing the max on volatility, like a high VIX, that's when you have these opportunities. Remember, 30 to 45 days out. You can ignore the Greeks and not have any math anxiety. It's another thing you learn what to do today. How this is a neutral strategy is also something you learn. And directionally, here's the other thing too, is let's say you're bullish, okay? Then what you would do is keep your put strike prices, instead of being like I had these spaced out where the market was right in between the credit spreads, the call and the put spreads. What you can do is if you're bullish, you have the put spreads closer to your strike price and your call spreads further out to the upside. Okay, that's if you're bullish, because you'll get more of a credit for the options that are closer to you. So you probably would gain more, get a bigger credit on the put spread, and looking for a bullish move. So if you were neutral to bullish, you would have the put spreads higher. If you were on the same as the opposite for being bearish, you would have your call spreads closer to your market price, looking for the market to go lower, and you would get more of a credit on that side. So remember, there is no market bias, or no bias by yourself when it comes to putting on an Iron Condor. Anyone can apply this strategy, and best of all, you get paid first with defined risk. So remember to maximize your option trading potential with eOption for stocks, ETF, and options tradings. Free option strategy toolkits like Option Play can help you, and option strategy guidebook also at eOption. There's a free paper trading account you can use to test these strategies and then answer these questions and then try them out for yourself. And then ETF and stock trades are also commission free. Remember that at eOption. So, all right, questions. Let me get to this. All right, so first for Denise, would this strategy be considered day trading? Absolutely not. This is not a day trading strategy. Remember, this is 30 to 45 days out. Looks like 4 trades of the same stock in one day. No, it's not 4 trades. It is 4 trades because you're using 4 options, but remember, they have the same expiration month. 2 of them are calls, 2 of them are puts, and then 2 of them you're selling and 2 of them you're buying. So they are 4 separate trades, but they're done simultaneously. Can you do them on different days? No, you have to when you put on an Iron Condor, you are putting them on at the same time. Now, for instance, if you already had a call or put strategy on, if you wanted to, you could leg into an Iron Condor, but would have to be certain reasons why you do that, and that's a whole webinar in itself, so we're not going to get into that. That's a big intricacy. All right, for David, let's see. This example says that Microsoft was 288 and that would have put the call spread was in the money at the time of entry. No, the call spread was out of the money because at the time Microsoft was at 228, not 288.83. So that's why it was not, and it was in between the 2 different prices. The 228 is below the 250 and 240 calls, and it's above the 220 and 210 puts. So that I don't know where you're getting 288 for that price of that day. So I can go back to the chart on this, but I don't want to lose the slide. Let's see. So both the call spread and the put spread were out of the money. David, is that normal? I'm not sure. I think that's because you're referring to the other question. Let's see, Paul, could you please do a session on simple SPY QQQ call and put options maximized today? Okay, let me see. Today I made a 112, 3 Qs calls and made 330. Okay. That's a lot of markets to cover in the next couple of minutes. But yeah, could I do a session on simple SPY, QQQ, and DJI call and put option maximizing profit? Yeah, we could. That would be a great topic. I will talk to Gina and Scott from eOption, and that might be a topic of doing the indexes. I was in the S&P 500 for 20 plus years, and I still trade and watch the indexes. So yeah, we could do an index option webinar. That would probably be a good idea. Thanks for coming up with that, Paul. Let's see, for Robert out there, thank you. So you guys are, bro, that goes to those guys. Well, you're welcome. I'm sure they want to say the same. Oscar, what is the minimum amount to open a Regal account? That's where you got to talk to those guys. Chandra, can you identify the difference between Microsoft and Amazon where the max loss potential is different? Yes, with Microsoft, remember that was where your maximum profit was around $400 and something. Your max loss was 500 something. With Amazon, both that and the Tesla, between the 2 credits of the call and put spreads, those came out to a plus $1,000. So remember that we were using $10 wide spreads. So the maximum risk on any of those spreads is $1,000. You can only lose on one of those spreads. That's why the 2 credits, they pay the difference of you can only make so much and you can only lose so much. Normally a credit is below 1,000 between the 2 spreads. In the case of the Amazon and Tesla, because of volatility, you would be able to get off at a higher than $1,000 credit between the two spreads. So that's why Amazon was their maximum loss was no loss. You could only make money on it. It was just, I think, only a couple of $100 was the worst case scenario if the market moved against you. Okay, so for Ravi, let's say, Ted, there might be other stocks that are active for the strategy to minimize risk. Tech stocks, trade premium, other options. Yes, there are plenty of other stocks, without a doubt. Tech stocks, because they're big high flyers, this can work for you and against you. Right now, because the market's trending on highs, I wouldn't say that Amazon and Tesla are overdone. They're in incredible bull markets right now, but it doesn't mean that they're not set for a little digestion or a correction. They are already, they're not infant stocks, whereas there's certain stocks that are so young that they're breaking out and they're growing to at a rate that is much higher than certain ones. So with that volatility, Iron Condors become a little bit more difficult. So remember, if you're going to put those on, always look to have at least a credit of around $600 to $700 between your two spreads, between the call and the put spreads. Obviously, getting over $1,000 is not something that happens all the time, but it can happen. Just like I had it in those, I was looking for other ones. Those were the only ones in those two stocks. Everything else would have been below it. But there was a lot of Iron Condors that you could have gotten off between $650 and $800 at that time also. So, and that's like I said, if you can come close to that, that's almost a free trade. Now, remember, there is no free money in trading. There's sometimes opportunities you can capitalize on, but they're not atypical. They happen every once in a while. Okay, so let's see, Rob, again, I am new to the strategy, but just some observation. I mean, stocks trading under 100 that are active. Yeah, they don't have to be above $100 to put on Iron Condors, let alone have this type of volatility. It's just that I use these because, once again, when you're learning a new technique, you should use markets that you are familiar with, trade markets that are liquid. So to use ones that I know everyone is very familiar with, that are out in the news, that I know no matter what are going to be talked about a lot still for the next few months at least. That's why I picked those. Also, because of the fact that there's so much volatility, remember, you're selling volatility, you're selling credit spread, you're bringing in money. So the higher the volatility, the more potential you are to get a bigger credit. Time decay doesn't necessarily work in the sense of like it does with certain strategies where time will help erode. So if you sell high volatility or low volatility, time works in your favor. Time doesn't necessarily work so much in your favor as it will with other spreads, but if you sell high volatility as it drops, it definitely helps you increase your credit, which no matter what, anything that you can, any variable that you can have that helps to give you a higher credit, and the more often you do these trades, one, the more money you'll make, and the less you will lose over time as well, because you won't be taking losers as well either. Remember, I said, don't take trades like that are under $500, because you're not even at a 1-to-1 ratio. You have to make money too often to come out of any shortfall that you would have with that. All right, a couple more questions here before we turn it back to Gina. 2 questions. You always close the bear on the call side at the same time. Yeah, you close both positions at the same time, because if you don't, then you're not closing the full position. That would be legging, either just getting out of one leg, and then you go from having an Iron Condor to having either a call or a put spread on. So yes, when you are done with the Iron Condor to lock in your money or lock in whatever loss you're at to get out of, you would get out of both spreads simultaneously. All 4 options would be, you would buy back the ones you sold and sell back the ones that you bought. Okay, so let's see, 2 questions. You always close bear. Yeah, we got that. Okay, we got that one for Rosita. All right, keep on going down here to Kent. Do you purchase all 4 contracts at the same trade? Yes, you do. Both credits are done simultaneously. Let's see, Rosie D. If the trade explodes to one side, can you close the side, roll it out, down, and still make money and leave the other side? Okay, once again, yes, you can close one side and leave one side out, but that's not what you're trying to do here. Remember, when you're trading an Iron Condor, the whole point is to generate a credit, define your risk, define your potential profit, and execute that trade. What you're talking about there, when you're hanging on to one part, remember that time is ticking down. So once you get out of one leg, you no longer have an iron condor. So if let's say you did take the side with the most credit on it, then you're margining out. Then you're using part of your account then, because you've already taken a profit that will still go against the potential loss on that other spread, which just makes it then higher because now you've already canceled out one. So yeah, and that's also when you start doing legging around like that, that's why you get opportunities where one side you can get such a huge credit, because people are legging around spreads. That's a topic all in its own for a whole webinar, so I really don't want to get into that one. All right, let's see. And please explain how you get out of the spread. How you get out of the spread? Well, you go to your platform and you just, well, usually you can do a one tap to get out of most positions. You can do an instant execution to get out of them. So that's one way to do it. Or you could, I guess, depending on your platform and how you put them in, you can just individually pair them up and get out of them. But like I said, I would just get out of them simultaneously and execute, just to go to market. And that's pretty simple to use on any trading platform, whether it's eOption or any other trading platform. All right, how much money in the reserve does such a trade take? Okay, so in the reserve, remember the first one was the Microsoft. Your highest potential profit was $400 and some. That was your credit. So you had to have just over $500 in your account as your risk capital in case the spread went against you. So for that trade, even though you took in $400 and some, you needed to have an extra $500 and some to cover in case the market exploded against you. Okay, now if you got out of it before the market, did explode one way or another, it's still, you have to have that money in. As long as you had that position on, you have to have that maintained in your account. Otherwise, you'd be kicked out of your position. Let's see, for Blake here, option pricing is complicated and had to see in the numbers because they are relative underlying price. What kind of stocks are able to find these no loss situations to help me find them? Remember, the no loss situation, to find this, when they do happen, it happens when you have high volatility and you also have your underlying asset towards an extreme, meaning near its highs or near its lows. So remember that this is something that doesn't happen every day, doesn't happen all the time, but it does happen. So, and you have to be there in the moment. So is it a day trading situation? No, because you're not doing it every day in and out of the market. Is it a day trading situation in the sense that you have to be there around when it happens? Absolutely, yes, you do. So in order to get them on, you have to be aware of the market being volatile at that moment, So in my case, that was, there was volatility, the VIX was screaming, indexes were rallying, and then there was all kinds of other markets that were coming on hinge. So volatility across multiple markets, different asset classes was high, which meant that volatility in these stocks, especially that was right around, I think, when Elon Musk was getting involved with Bitcoin. So just combining Bitcoin and Tesla together, think about that, what it does to volatility. So once that happens, you sell into those spreads. Remember, most options expire worthless. So selling options is where 90% of the money is made. And I'm not saying that means just go out and start selling options. You have to have the right strategy. So yes, just remember, so Blake, don't think that you're just going to find no loss situations. Believe me, if there was that common and all you could do is just do that every single day, I wouldn't just be doing this webinar, because I certainly wouldn't be talking about it. So but you can get closer to like I said, that $700-800 credit range, which definitely puts you in the more profitable opportunistic situation. All right, for Teresa, we're almost done with the questions here. How much more margin do you need to put this trade on? Once again, you don't need any more margin than was the difference between your credit that you take in and your potential loss. So these spreads were $10 wide. Remember, both the call and put spread must be the same distance. They're all the same option expiration month. They must be the same distance, meaning if they're $10 apart in the call spread, they must be $10 apart in the put spread. Then you take a credit from both of them. Remember, you can only lose on one of them potentially. Okay, if the market goes nowhere, you make money on both. If the market goes through or into one of those spreads, that is the spread that you will lose money on, okay? But you already took a credit in. So you take that credit plus the other credit, which is locked in because the market can't be in two places at once. And whatever that difference is, you know, with, like, for instance, like in the Microsoft example, you would have taken in a credit for around, I think it was $450. Your risk would have been around 550. So if you took in 450, and then as long as the market was somewhere in between the strike prices in the call or put spread, then you would not lose a full 1,000 minus the credit. You would be somewhere lower than that. But if the market exploded above or below those credit spreads, then you would be out the full loss on that, which would be the credit minus that difference. So in that case, 550 would have been your maximum potential. You don't need any more money in your account. They don't come looking for more money. You just want the head of money that you need. All right, two last questions and I'll turn it to Gina. Can you determine entering and exiting the strategy in eOption? Yes, you can use their platform to scout around and look for trades on there, and also for the pricing, and just you have to go on the platform and do it. Is there a possibility being assigned? No, there's never a possibility of assigned, because no matter what, you're in between the strikes, so that one cancels out the other. So even if one gets exercised on, the other one covers that one. So no, you never have to worry about it being assigned any stocks. And one last one, is there a possibility stock price moves outside the range of the Iron Condor that you get extra? Yeah, absolutely, for sure. And yeah, but remember, you're never assigned. Okay, if it goes outside the call or put spread, no matter what, you don't have to worry about being assigned, because one option covers the other. So don't worry about any type of assigned risk. This, once again, was a very neutral. Delta neutral is actually the kind of trade it is. It falls into that. It's not a full delta neutral trade, but it falls into that category. So yes, remember, once again, very important, don't forget this, your risk was defined during these trades. No matter what, it was only that difference between the credit you took in and the spread between the two strike prices, okay? You cannot be assigned, you cannot lose any more money than that. Okay, so with that, I just want to give you one last reminder about me. I am Teddy Keckstedt from Forex Trading Unlocked. Check out my YouTube channel for other videos, and check out the book I wrote, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And with that, just remember, you have more options resources at eOption. And now I'll turn it over to Gina.
Okay, great. Well, thank you so much, Teddy. That was very interesting and informative. And thank you to all of our attendees for taking the time out of your busy day. We got an excellent turnout today, and thank you for all of those great questions. If you have more questions and Teddy didn't get a chance to address it, please feel free to give our trade desk a call. The number is 888-793-5333. Again, 888-793-5333, and they're happy to answer any questions that you have. There was one question during the Q&A. Someone asked if there was a minimum to open an account. And I just wanted to let you know there is no minimum to open an account. You can go to eOption.com and just click on the open an account button and fill out the online application to get started. And there's a lot of great benefits to opening an account with eOption. As we've mentioned, it's zero commission for stock and ETF trading, and options are just 10 cents per contract plus $1.99 per option trade. So that's one of the lowest in the industry. You also get free education. We have free tools such as Options Play, as I mentioned in the introduction, where that's a tool that screens thousands of stocks each day and highlights potential option trade opportunities for you. And that's normally $500 annually, and that's free for all of our customers. We also offer free research reports, and something new is we're offering free Zacks research reports unlimited on all your favorite stocks, and that's free for all eOption customers. So if you're not currently a customer, we hope you'll give us a try and just go to eOption.com, and there's no minimum to get started. A few people have questions on how they can get a video recording, and that will be available on our website at eOption.com. We have a tab, webinars and videos, and you'll find it there in the next few days. It's also on our YouTube channel, eOption's YouTube channel, and we'll also be sending an email out to all the attendees of this webinar. So if you'd like to watch any part again at your leisure. We also have more education on our website at eOption.com. We do strongly support education. And we do have a great service. It's strategy links. So if there was something on this webinar you'd like to learn more about, such as call spreads or put spreads or even iron condors, You can click on the link and it'll tell you a description, what's the motivation to use it. Some of them have videos. So that's a great way to get started and learn more. Again, as I mentioned, our YouTube channel, we just recently revamped it. So you'll find all kinds of playlists there, whether you want to learn more about spreads or you're a beginner trader and you want to learn about covered calls or learning more about options play, our trading tool. There's all kinds of great playlists on there. So we strongly encourage you to go to our YouTube channel and subscribe. And if you can mark your calendars for our next webinar, it's in just over a month on Wednesday, April 21st at 1 p.m. Central Time. And it's on leverage our trading platform to maximize earnings season. So Sean Heron, the president of eOption, will walk you through how to use our tools to identify option trading opportunities and how to access our free research reports, news, and create watch lists. He'll also walk you through our trading platform, and you can see how easy it is to place option orders, spreads, stocks, ETFs. So we strongly encourage you to sign up for that at eoption.com/webinars. So again, thank you for attending. We know you have a busy day and we appreciate you taking the time out of your day to join us. Be safe and we'll see you soon at our next webinar on April 21st. Thank you again and have a wonderful St. Patrick's Day. Thank you. Bye now.